And good morning, everyone. John Hutchinson with Traders Reserve, along with Jeff Wood for July 14, 2025 edition of Breakfast Club. Hope everyone had a good weekend and a lot to share with you today. No long preamble, but let's get down to business. We'll start with the weekly income report first. And let's see, we had a really good week last week. I think we're going to continue to see this. Um, Sort of a caterpillar effect where we get a week of a large number of trades closing out, a little bit of a lull, a large number of trades closing out, a little bit of a lull, and that seems to be happening in or after heavy data weeks. So like the heavy data week is the lull, and then the week after is when the market sort of gives us our exits. So last week we started out with Income Masters, and the first week of the daily trading program in the Millionaires Trading Club. And for the week between both programs, 12 trades closed, over $4,000, over $4,100 in net income combined on $30,000 in capital for a pretty substantial 13.6% return on the week. Looking at Income Masters, one of the I don't want to call it a big winner. I don't mean it that way, but one of the big wins was a longer recovery trade in Domino's Pizza, stock symbol DPZ, which netted over $400. But that trade dated back to April, right around the April collapse in the major indexes. And so that pulled in an extra $400 in cash, but we were able to manage a position from an initial debit to a credit to a positive, and happy to take that one off the board. Hopefully, we can take some more off the board as we go through the rest of July. For the week, 7 trades closed. Average days in trade 25. That's largely because of that Domino's Pizza trade. Total capital across all trades, 19,471, $3,090 in income. A good portion of that was also a position in our perpetual income portfolio on Southern Company, stock symbol SO, which we closed for a $1,700 profit. That was a combination of calls, puts, and the stock moving in getting called out above our call, and so a nice return on Southern Company. We've been trading Southern Company for 4 years, maybe 5 years. It's one of Dave's favorite dividend stocks, mixing in puts and calls on that stock in the utility sector. So we will be trading that one again. And we did, as I said, we allowed shares to be called away. So we had profit from the shares and from the covered call. So a pretty big win there. So overall return on capital, a little bit elevated because of that position at 15.9%, but overall a very good week for Income Masters, bringing our net for the year to 22,318. We're off to a very good start in July. Let's just keep the ball rolling. In in the Millionaires Trading Club, as I said last week, on July 7th, we began the daily program where we were meeting with Millionaires Trading Club members every Monday through Friday from 11 a.m. At 11 a.m. Eastern Time. And for the week last week, we closed 5 trades. 4 of those trades were opened in the same week. So 4 of our newest trades that we opened last week were closed within 1 to 2 days. And we did close a longer dated XOP position that dated back to our May Millionaires Trading Club event. We closed that for a loss of $52. That's $52 total. It's $26 per contract at 2 contracts, so a $52 loss included in the numbers here. So net income, 1,095, 9.6% return on capital, total capital across those 5 trades, just over $11,000. So a great start to the new version of Millionaires Trading Club in terms of meeting with you every day, making trades throughout the week rather than just once a month. Uh, and I think if I remember correctly, that's right inside of the goal that Dave has set on a weekly basis of $1,000 to $1,500 in average weekly income. So off to a good start for the first week of Millionaires Trading Club. That brings our total income for the year to 7,503. And just as with Income Masters last week, we're off to a very good start for Millionaires Trading Club. Let's see what Jeff and Dave have up their sleeves for this week. Quick program note, later this week we will begin opening reservations for the October Millionaires Trading Club live event, which is being held at the Hyatt Place, Silverton Village in Las Vegas, Nevada, October 21, 22, and 23. We've reformatted this event. It's going to be really cool, really fun. We have a really exciting challenge for those of you who are attending live in Las Vegas with us. Tickets will be available to attend in Las Vegas or virtually. And I will have a special Breakfast Club session later this week to cover all of the details on the Millionaires Trading Club event. If you are a Millionaires Trading Club event member, Millionaires Trading Club member from last year, last October's event, please make sure you check your email for your early reservation because the October conference was included with your membership for this year. So please don't miss out on a seat in Las Vegas if you are attending in person. If you're attending virtually, less important, obviously. But if you're planning on attending in Las Vegas, if you didn't get the email to reserve in advance, check in with Mike or Leslie in support@tradersreserve.com, and they will make sure to get you your reservation booked. We do have the hotel link. We'll get that out to everybody as we get through the end of this week. And again, that's October 21, 22, 23. And this coming October at the Hyatt Place, Silverton Village, one of my favorite little Hyatt places because we get the food from the Silverton Casino, and it's some of the best food we've ever had at a live event, hands down. So with that, I'm going to turn things over to Jeff. Jeff has a lot to cover with you today. And Jeff, let me stop sharing and give you the screen.
All right. Hello, everybody. Can you hear me? Okay. Everyone have a good weekend? While I get set up, we'll do, oops, I know what I need to do first. I need to put my presentation into slideshow mode. All right, everyone awake? Everyone ready for another week of trading? I got nothing. No one's responding. Quiet room
Nope,
today. All
nope,
right,
nobody's awake.
no one's awake. Grab your coffee. Come on. I was up until like about 2 in the morning doing this presentation, so so please don't make it for nothing here. Okay. Here we go. You should be able to see my screen. Okay, so this week it is all about the earnings. We have earnings largely kicking off. Yeah, we had some earnings last week. Obviously, Delta Airlines blew earnings out of the water. That really helped out the rest of the airline sector. It'll be interesting to see if the rest of the airlines now, that would be like Southwest, Love, Southwest, which Southwest Airlines, American Airlines, some of those also helped. Those had pretty good days last week after Delta reported their earnings. So now if American Airlines and some of those also have good earnings, that should really help that entire sector. But what I'm looking for, obviously trades, that's what we're all here for. But what I'm looking for this week is to learn a little bit more or listen to the CEOs and CFOs and see what they're saying, how they're reporting out on their earnings. So large scale tariffs, not yet implemented. We've certainly had some tariffs going on. We've actually had record-setting $100 billion plus from tariffs so far. Not all of that is from that exact date, but anyway, we've had pretty good numbers as far as money coming in from tariffs, and that helps the administration say, hey, we're on the right path. But and also, depending on how these future tariffs get negotiated, or if they get negotiated at all, or whether the administration will back out again as we get closer to August 1st. We don't know any of that stuff, but we'll see kind of what that happens. So what we're looking for is, yeah, we've had some tariffs so far. So what are those CEOs, what are those CFOs saying? Are they going to come out and say, sorry, that's the next slide. So for this one, what we're looking at is, will consumers keep spending as price of goods move higher? What they're trying to do is obviously get everything to be built in the US. However, if things are built in the US, prices are still likely to move higher just because there's a reason why things, were built in other countries, in some of the lower cost countries. So if they move manufacturing to the US, prices are still going to go higher. If they increase tariffs, prices are still going to go higher. At least from the products I see, I think I said this last week too, there was stuff that I was looking at buying in December that was about $90. I just went to Lowe's, and that same exact product is now 130. So, and I'm not buying it for $130. So there's definitely a tipping point where consumers will say, hey, look, tariffs are great, moving manufacturing to the US is great, all that sort of stuff. However, I can't afford the products. And that's what we're just trying to see, is how much can we push those prices higher before consumers say enough is enough. But what I'm also looking forward to is seeing what the CEOs and CFOs will say. Are they going to continue to guide lower? There was a lot of talk last earnings season, where they came out and they guided lower, saying we don't know what's going on with tariffs, so don't expect as much as far as earnings go. And now, they're giving themselves basically an opportunity to quote unquote beat earnings because they guided so lower last time. So the question is, will they guide lower? Will they beat earnings, this time? Because we haven't really seen those large scale tariffs in play yet, and then continue to guide lower. Are they going to even mention tariffs at all? Or tariffs just, the 24 news cycle on tariffs are gone and we're on to other things? Or maybe they're going to mention future rate cuts and spurring growth. So we just don't know how. And I think the how things are said are going to be way more important than the earnings themselves. However, we talked about this on Wednesday. We know the S&P 500 is definitely stretched as far as earnings estimates go, and the current price to future earnings. So we know the S&P is stretched a little bit. So we'll see how that goes in the weeks ahead. As far as the economic calendar goes, we have a very busy week with CPI on Tuesday. Luckily, today we can kind of just get all of our positions in place and do what we need to do. Very quiet today. But tomorrow we get CPI coming out. And again, any one of these things, the forecast is, let me get my mouse laser pointer
Let's
here.
let's take it. Let's slow down here for a second, because
Sure.
the two key reports are going to be the CPI,
Yep.
and if you look at the previous CPI report was 2.4%, and the forecast is 2.6.
Yep.
That is moving in the wrong direction.
That's definitely moving in the wrong direction. Yeah, absolutely.
And what that will affect is rate cut expectations for September. Uh, Flat out will tell you that the way that the FOMC minutes were handled last week were largely positioned as being dovish, because a few members of the Fed said they would consider a July rate cut, but the core voting members are not considering a July rate cut, regardless of the pressure coming from the White House or on social media or any of that crap. They are not cutting rates in July. There's not an impetus for cutting rates at this time. And the earliest that they could cut is September. However, if that CPI report comes out anywhere above that 2.6%, that is likely to remove the discussion for a September rate cut and push it later in 2025. And that's not priced into the market at current levels. And the second major report is going to be retail sales as a proxy for how the consumer is holding up in terms of consumer spending. Not in the consumer spending report, but how are retail sales performing as a function of consumer spending. And again, any surprise to the negative in that report is not priced into the market at these levels.
Yeah, and I think as far as retail sales go, because sort of some of these tariffs have been a little bit less than what they were initially talked about during Liberation Day. Some of we saw that rush to buy right after Liberation Day, and now we're seeing that maybe tariffs aren't so bad, and so then we saw a little bit tick higher in retail sales, but But again, we'll see because some of these things haven't really truly been implemented. And so we don't really know how bad, or maybe it's not going to be bad. Maybe it's all going to be fine and we're all overblowing this, but
Maybe.
maybe,
And
right.
the last thing to keep an eye on, although it's not listed here, are continuing claims in unemployment, which
Yep.
are moving toward the 2 million mark. And even though the unemployment rate went down in the most recent jobs report, that is a little bit of a mirage because it is getting more and more difficult for people to find jobs. So as continuing claims rise, that's that's the no hire problem. And while it is true that the weekly unemployment claims continue to be in a stable range, that's the no fire zone. It's that no hire that becomes the problem. We have to get, we need to get continuing claims to go the opposite direction to underpin growth in the economy. Otherwise, you're trying to get the same level of growth from fewer workers. That's not likely to happen, especially against the backdrop of rising prices.
Yep. And there's so much more to than just the unemployment claim number, although that's usually what I kind of look at. But there's how much of the establishing workforce after a certain period of time actually just falls off that report too. If so, there's the participation rate and some of those other things that are also important within that number. But the weekly report that comes out is showing a slight uptick. But again, in recessionary periods, we're talking about usually, the 4 week moving average being above 300 to 400,000 is when we start saying, hey, that's a warning light. So right now it's ticking a little higher. There are some things underneath the surface that we should be looking at, but right now that specific number is not too much out of the ordinary. All right, so want to look at this is our what we looked at last week. And we said, hey, when the S&P 500, when 80% of the stocks in the S&P 500 are trading above their 20-day trading moving average, that is a time where over the next 5 days, we typically have about a 1% correction to the down. It's not a correction, just a 1% move to the downside. And then when we, said anything above 80, especially over 90, you may see the sector continue to move up, but those are usually sectors where that move has already happened. In last week, we had a number of sectors that were trading above, or 80% of stocks were trading above their respective 20-day moving averages. So we talked about this last Monday, saying, hey, this might be a little bit of a weak, a little bit of a softer week, just because we have so much of a strong move that had occurred. And sure enough, over the last 5 days, S&P didn't really lose that much, only lost 0.3%, so not too bad. But some of the sectors certainly underperformed the S&P 500. Energy outperformed, or at least over the last 5 days. And then, information technology, industrials, and utilities. So those are a little bit more defensive in nature as well. So it's maybe a little bit of a sector rotation from some of those risk on ones to a little bit more defensive. As far as what sectors are beating the 1 month performance of the S&P 500, well, energy just edges out the S&P 500. But not many others, information technology and industrials. But a lot of the individual sectors are lagging the performance of the overall S&P 500. So you just have to find the right stocks to trade versus picking one sector. But the risk on the information technology sector, at least it did edge out a slight gain last week. Now with earnings coming up, we have a lot of financial earnings coming up this week. We have, and then, the mega cap stocks, Meta, Facebook, all that stuff. Those, if they have positive earnings, that's obviously going to drive up that information technology sector. So, what do we have this week? How's it look? Well, a lot of these 90s or above 80s dropped down quite a bit last week. So consumer discretionary is looking maybe a little bit frothy there. Industrials maybe looking a little top heavy. Materials maybe looking a little top heavy, and utilities maybe uh, again, I'm not saying that utilities as a sector can't continue to go higher this next week, but if you're looking for individual stocks within utilities and you're like, oh, this is the time to get utilities, you're just gonna have to be very careful about what stocks you're looking for within that sector. That's all. Now I have put green stars next to a few because I'm going to switch over to Excel and show you something in just a second. So if you want to take a screenshot of this, that's fine. But consumer staples is one that I'm looking at. Financials, one that I'm looking at, obviously with big bank earnings coming out this week. In real estate. And so one of the things that moves stock prices, or one of the major things that move stock prices, even though nobody wants to trade over earnings, but one of the things that moves stock prices, is earnings. So, and how, and most of the move, or there's quite a bit of the move that happens in a stock because of earnings reports. So, so it's understandable to be cautious while trading over earnings, but it's something that we need to certainly look at.
Let's stay here for 1 second. The one thing that I would point out on this is when you're looking at the sectors that are uh, at the opposite end of the spectrum, at the high
Hmm.
of the averages, is earnings disappointments, and those 15% moves lower. Excuse me. So when one thing to keep an eye on when you're in any of your trading, whatever you're trading, stocks, options, doesn't matter, is be wary of stocks that are at highs or at extreme highs, and the potential for an earnings disappointment. And that's likely to reset or move that stock substantially lower. I would not be surprised if we see more of those gap down moves during this earnings season, um, in part because of the lowered expectations, but also because prices have returned to sort of extreme highs, extreme levels. Anyway, carry on.
Yeah, no, absolutely. So this is something we showed last week too, when the SPX percentage above their 20-day moving average was greater than 80, because that happened last week. So this is what we talked about on Monday, is what to expect. So last Monday we said what to expect in the next 5 days. Probably, a little bit a weak move. Again, the SPX only dropped about 0.3%, so better, I guess, than the average, but it was certainly a weak or softer week. However, in the next, so if you get that out of the way, the next 10 days, in four out of, and this is only taking over the last 12 months. So in 4 out of the 6 times that has happened over the last 12 months, 10 days later, so that would be, this upcoming Friday, the market was up. So we might see a little bit of a rebound that might be, maybe we get that from some of these earnings plays that come out this week. So if your portfolio, was down a little bit last week, there may be some brighter future ahead, at least according to the numbers. So with that, I'm going to stop share. I'm going to go over to something in Excel really quick, and I want to show you kind of what I'm looking at for the future, for the next couple of weeks. So just give me a second. Um, All right, so now let's make sure this is coming across. Okay, now forgive me, I'm not a UI or UX UI expert here, so I'm not saying this is the most beautifully put together Excel sheet. Actually, let me move these so we can see a little bit more about what's going on. But this is something that I actually I was not intending on doing this all last night, but I got a little bit passionate about this and ended up staying up way too late last night to do this. But what I wanted to show is this is essentially pulling in um, the last 10 years of data for the SPY. And what it is showing is seasonal data. There's other platforms that can give you seasonal data as well. But and we've looked at it at on Thinkorswim. But um, so being today's date is 7/14 over the 5-day average starting on 7/14, all trading days around 7/14, 5-day average from here over the past 10 years of trading the SPY, it has a positive move of about 1.26%. The next 10 days from 7/14 has a higher expected move. The next 15 trading days from 7/14, again, higher move, and the next 20 days. So seasonally, we've talked about this before, but seasonally, July tends to be a stronger month. Why does July tend to be a stronger month seasonally? Because earnings. And if earnings continue to beat and companies continue to beat their earnings, then July will continue to be a strong seasonal month. However, what we do need to be a little bit cautious about is let's just focus on this column here for a second. And you can see that, so now starting on July 15th, the next 5 days starts to go down quite a bit. So the 5-day period starting 7/14 definitely a lot stronger than the 5-day period starting 7/15 or 7/16 or 7/17. So these numbers really start going down. And so if you go all the way down to about July 23rd, yes, we have the 5-day period starting on 7/17 does have negative expectancy over the last 10 years of data. But what is more interesting to me is you have 7/17, then 7/23, then going on to 7/26. So these negative numbers, these two negative numbers come a little bit closer together. Then right around the end of July, we get a lot of negative numbers all sort of grouped together. So what this is saying seasonally is that yes, July may be strong over the average for the SPY over the next 20 or so days. However, that's starting 7/14. If you're initiating bullish trades towards the end of July, the SPY over 5-day periods, or even over 20-day periods, 15-day periods, 10-day periods, is a little bit weaker. So this is the time where we're going to start maybe looking at some of our positions, maybe tightening some stops, maybe adjusting how we're going to trade in future setups, because what we're seeing is a seasonality coming in a little bit weaker towards the end of the month. So what I did, I'm going to spare you all the time of me doing this one ticker at a time, is now over here, I did the sector ETFs, and I looked at their average 5-day, whatever, all starting from 7/14. And so what we see is the financials over the next 5 days, 10 days, 15 days, and 20 days, starting again on 7/14, tend to do quite well. So the financials 20 days from now has an average move about 3.68%. And again, that is due mostly to earnings. Industrial sector was another high performer over the next 20 days. But what you see, this note that I have over here, is some of those July 23rd. So similar to the SPY, where we had a negative number, I just didn't write it down, but negative number on the 17th, negative number on the 23rd, negative number on the 26th. So I wanted to say, like, okay, how is this going to perform compared to the SPY? So if the SPY is starting to get a little weak at the end of July, how are these sectors going to perform? And so the financial sector, even though over the next 20 days was positive, it was kind of mixed. It had some positive numbers, some negative numbers, and so on. The consumer staples, though, as expected, so if the SPY is going to get a little weaker at the end of July, then you look at defensive sectors. So consumer staples, well, it turns out towards the end of July, consumer staples over the last 10 years has been performing higher. It may not be as high of a percent as financials, with the 20-day average only being 1.88%, but it has a higher probability, if you will, of or a more consistent move higher at the end of July than financials or industrials. So that's why I highlighted this column. If there's a little bit more consistency in the data, I highlighted this column if they had a good, average 20-day move. So utilities, even though I did mention just a second ago that utilities are a little frothy at the point, so maybe not this week to get into, but towards the end of July, utilities tend to perform better, and real estate tends to perform better at the end of July. So again, those are those defensive sectors. The data over the last 10 years is showing that the defensive sectors tend to perform at the end of July, and that the SPY tends to perform not as good towards the end of July. So just want you to prepare for that. So then what you do is then once you take all this information, where's Jim? Jim always said, I don't have much of a life. So this is for Jim. So then I tried to find like, okay, well, what stocks in these sectors that I've highlighted are also perform well? What stocks go higher at the end of July over the last 10 years? And so I identify and happen to be within these sectors. I tried to narrow it down to those strong sectors that I'm looking at, and then stocks within the sectors. So Nucor, Capital One Financial, they're in financials. Procter and Gamble, that it would be consumer staples, XLP, MasterCard financials. So those are all different stocks that perform well really over the next 20 to 30 days, 20 to 40 days ish. And those perform well, and they are in some of the sectors that also perform well over the next 20 days. And so you can do this in a bunch of different ways. You can do cash secured puts. You can do all of these. I just set up as example debit spreads. And part of the reason that I did these as debit spreads is if you take the difference between the 580 and $5 and 280, that particular debit spread is going to cost you about $2.20. The most you can make, it's a 5-wide spread, is $5. So that now this spread on Nucor, it is a debit spread, which I know debits are kind of like a 4-letter word sometimes at Traders Reserve. We tend to do more option selling, but this particular debit spread costs you $2.20 for the ability or the potential to make $2.80, right? Yeah, I'm doing my math right. So you have a better than 1-to-1 risk to reward ratio, or reward to risk ratio. And so anytime that I can make 100% return on my money on a stock that tends to move up, in a sector that tends to move up, like those are the ones that really pique my interest. So if you want to take a screenshot of those, please do your own investment research on those, but you can take a screenshot of this. These are some ideas. And again, this is all last night option pricing, so they may be subject to change as the market opens. They're just trading ideas, not recommendations. I'm not going to follow these, as far as the group goes or anything like that. But like I said, do your own research and see what you think about that. But I also wanted to look at as a potential hedge trade here, what does the VIX do? So starting on 7/14, over the next 20 days, the VIX tends to move up. So as the VIX is moving up, that means volatility is moving up. If volatility is moving up, that tends to mean stocks move down. So all of these things are in play, kind of showing you what is ahead or potentially ahead for the end of July. Not saying that's going to happen. Like seasonality is what it is. It's just data. Trump could say something that can completely change it. We could have another COVID thing that could completely change it. Maybe the Fed, reduces rates and that changes everything. So I'm not saying just because the data says it to be bearish in July, but it's important information for you to look at, I think. So then the average 20-day performance on the VIX actually goes higher about 3%. But look at some of these other numbers. Starting on 7/15, going out 20 days, 10% higher, 10%, 15% higher, 25% higher, 32% higher from 729. So VIX is very low. So, some of these percentages seem pretty extreme, but like, if the VIX is down at 9, a 32% gain, on a $9 or a 9-point VIX isn't that much. I'm just saying what the data says here is that as we get towards the end of July, the VIX tends to perform better. If the VIX is performing better, that's introducing volatility. So you may want to look at volatility hedges, things like that.
That's our summer swoon. August, the
Yeah,
late July to August period, the last couple of years, especially, have
yeah.
seen uh, sell-offs in the major indices and stocks. So I'm not surprised by that data, but that's a really cool way to look at it.
So that was really it. That's all I wanted to show. That's we almost got it done in 30 minutes today, but
So let's just put this. We've got a new core call
oh,
spread. Yeah,
sorry.
keep that
You
up for
want
just a
sorry,
second,
sorry,
just in
sorry.
case
I thought
anybody
you
wants to
were
jot those down.
I thought you were going
Uh,
somewhere else.
Capital One Financial, you have a July 25 call spread, 545, $8. So again, about a $2.55 debit. Procter and Gamble, an August 22 call, going out pretty far in time there. 515, 280 was the overnight pricing on that. And MasterCard, another option play for July 25. So two July 25 expirations, an August 1 and an August 22.
Yep. So,
And
and all of these are debit spreads. And the reason that some of them went out to early August just because New Core's seasonal information was a little bit tighter in the next couple of days. I can show you. Sometimes I'm pulling up too much data and this kind of twitches out here. So we'll see. Okay. So now, let's be real about this stuff. I'm not going to hide anything. Nucor does have earnings coming up right around August. So why does Nucor, starting on 7/14 over the next 20 trading days, tend to move up by 8%? Likely because Nucor tends to beat earnings. And so a lot of the earnings price is in this number. So when you start seizing, there's a lot of companies that will sell you seasonal information and they'll say, oh, look at how easy, it is. You just follow seasonals. It's a little bit, just before you get into seasonals, what you have to know is that a lot of the seasonal gains do happen around earnings. So, but anyway, that's so Nucor does have earnings coming up right near the end of uh, or early August. So the majority of that of their gains happened before August. So that's why I went with the August 1st and so on. So it's a little bit. I did pick strikes purposefully, or as expiration cycles purposefully.
all right. Well, then we will be back on Wednesday and at 8:30 with the next installment of Breakfast Club. And we'll have, obviously, with Tuesday tomorrow, we'll have some of the market data on hand to give us a sense of what's taking place. Uh, Outside of that, we'll also have a special event on Thursday. I'll give everyone details on that as we get to the beginning of the week here. But let's make sure we get off to our trading sessions here. 11 a.m. today, Millionaires Trading Club, 12:30 p.m., Income Masters. Markets look like they are in the red a little bit early on when I just looked a few minutes ago as Wall Street reacts a bit to more tariff news coming out of Washington. We'll see how that plays out for the rest of the day, but let's have a great week and close as many trades as we can. Jeff, thanks for all your data share and for staying up until 2 a.m. to do it. For everybody else, hope you have a great day today, and we'll see you in one of our upcoming live trading sessions and or on Wednesday morning at 8:30 a.m. Thanks for joining us, and we'll see you again on Wednesday.